Zach, we are back this week talking about pricing, which is definitely a topic we've discussed before, but we are going to get into the specifics of promotional pricing models that the cable industry has been running for, well, frankly, for decades.
Say someone has been running something for decades, that's typically not a good sign. It's not a good way to start a conversation. But before we get in today's podcast episode, I have to say, Gabe, this background, this is the last time you will see this studio behind me. We're change of scenery here, Gabe. I'm not quite moving next to you and inserting myself into your neighborhood as fun as that would with as much as you said about your neighbors. But I'm hoping next week we'll have a whole new studio, and it's really going to confuse the people who are watching the video podcast.
I love it. I'm excited to have a different background for you and for you to have a proper podcast studio. I was giving you a hard time that you're going to have to get some books to really artfully place behind you to make sure that you look as smart as humanly possible.
It's just a library of iPads.
That would actually be kind of cool. Like all of the iPads that you've accumulated. I still think it would be fun, and I could slide over, and you could just come and stand right here next to me, and we could do the podcast live in my little podcast studio. That would be awesome. But I know I can't get you to move to California.
No,
so
someday we will have an in-person episode. That's maybe not at Connections as well, but. Gabe, new studio next week, so I'm hoping we'll have a lot of new topics to talk about too. If not, we'll talk about the experience of me having to set up a new internet provider here. But speaking of internet providers, Gabe, what's going on in the cable industry here?
Yeah, so the reason we wanted to talk about this today is, and Zach, I think you and I are similar in this respect, in that we've been hearing this come up a lot in customer conversations recently, and specifically around promotional pricing. And the reason we wanted to, again, dig into this is I'm hearing a lot of providers who historically have not done promotional pricing look at doing promotional pricing as a way to increase take rates in areas that have maybe been a little bit of a struggle. We see a lot of providers that have gone in, built out infrastructure in specific areas. They see this great bump of take rates, and then all of a sudden it starts to taper off a little bit and things get a little bit harder. And what I've been hearing frequently in meetings that I'm in is that people are looking at, or are already actively doing, promotional pricing in those areas to offer a 6-month or a 12-month promotional rate that then increases after that. Well, guess who did that forever? The big cable companies. Charter did that forever. Comcast did that forever. And if you look at what's happened to those organizations over the last few years, it's not been great. And I'm not saying correlation is causation, right? I'm not saying it's only because of the promotional pricing that they ran, but
haven't they been burning subscribers?
They've been burning subscribers. I mean, cable operators lost 1.5 million subscribers in 2024, and 2025 didn't get a whole lot better. Charter stock is down more than 82% from its all-time high. Comcast market cap dropped by 1/3 in a single year. And I'm not trying to throw shade at these companies specifically, but the fact of the matter is that playbook that helped them initially get to where they were at from a subscriber count perspective, which was lock someone into a promo rate, raise the price after that introductory period, and then continue to repeat. It's still the default strategy for a lot of broadband service providers. And I'm starting to get concerned that people are trying to go back to that strategy. And I think it's a very, very risky game to play.
There's so much competition in the market. The strategy just doesn't make sense. Oh, you're going to, double, or you're going to increase prices after this promotional period, and the customer's either going to call us and complain, or they're just going to jump to the next provider kind of thing. It's not a win-win scenario here.
Yeah. Well, and again, these, the large cable companies ran this playbook for 2 decades, Zach, as we said, and anytime you're running something for that long, it's probably not a great sign. And their market caps are not good. I mean, they are down significantly, billions of dollars of value that have been incinerated in these organizations because they just continue to run this playbook over and over again. And, when we get customers used to buying based on price, well, then you know what they're going to do? They're going to buy based on price.
Exactly.
it really just, again, destroys that value longer term. So again, when you see these promotional rates in markets and you see how customers respond to them, it did work when there wasn't as much competition and the subscribers didn't have any places to go. But then fiber came into markets and fixed wireless came. And as we discussed on our last week's episode, Zach, Starlink came and Amazon is coming. Like you said, there's a ton of new competition in these markets. So something predictable happened. Again, subscribers who have been trained to shop on price started shopping on price. And, when those cable companies had those huge increases in prices after the promotional periods ended, then they started to go out and look for alternatives. And we know from looking at the data that when a promotional period ends, that's a massive red flag risk for churn. But if you don't have any promotional periods, if your pricing is transparent and doesn't change, well, then you're removing that churn risk from the conversation.
Gabe, and I know we talked about some of these big cable companies here. I didn't realize the all-time high here of Charter stock, September 2021 was $821. Now that's not a stock I follow here, but if we're talking about, we've been talking a lot about financials here between last week's episode and this week here,
I
but
know, getting really nerdy over here.
what's the latest number there, Gabe? It's not one I follow.
$143 as of June 2026.
So down 82%.
Yeah, it's not great, right? And think about what was going on in September 2021, right? I mean, this was coming off of COVID. All of a sudden, those companies who Charter and Comcast and other large cable companies who had been adding subscribers went on a whole other pace of adding subscribers. That was a really good time to be in the internet business in 2020 and 2021. So they were seeing these massive increases in subscribers. Their stock was trading at all-time highs. But again, they were running that same playbook. They were addicted to this subscriber count growth and getting there at any cost. And frankly, it's something that just incinerated a lot of value over time. It's something that's seen their subscriber counts dropping now. Charter shed another 120,000 broadband subscribers in Q1 2026, and it's something that's just a very difficult thing to come back from.
So if cable operators lost 1.5 million subscribers in 2024, 1 million in 2023, Gabe, I don't know if you have like the 2025 numbers here, but these are pretty big losses and the largest in the history of these businesses.
Yeah, I didn't pull the 2025 numbers. I need to probably go back and do that. I can tell you just from looking at the numbers on a quarterly basis that there were definitely significant losses in 2025 also. Where they've been adding subscribers is on the mobile side, where they're adding mobile customers to try and stem some of those losses. And that has been helping to an extent. But it's still, again, the reality is that, Charter specifically lost another 120,000 in 2026 of Q1 of this year. So it's something that's continuing to become a problem.
Oh, and by the way, Gabe, on last week's episode, we talked about how Starlink now has 10 million subscribers from their IPO filing. Those 10 million, I think that's globally, but those 10 million subscribers, they had to come from somewhere.
For sure. Well, and it speaks to, and again, I'm not saying that, promotional pricing is the end all be all for why this happened. There's definitely competitive issues at play here as well. The fiber overbuilders came in. But again, when many fiber overbuilders came into these areas where Comcast and Spectrum have been operating for forever, they didn't come in with promotional pricing. They came in with a different product and they started taking customers away with that different product that they were selling. And many of them did operate different, where they didn't want to offer promotional pricing. They saw it as a differentiator in those markets where they were competing with Spectrum or Comcast. Certainly fixed wireless has had a big impact here as well. I mean, if you look at T-Mobile specifically and you look at their filings, their subscriber count has seen a huge increase on their home internet services over the last 3-4 years, however long it's been since they actually launched that. But so there's multiple factors at play here. But again, promotional pricing trained an entire generation of subscribers to think of internet service as a commodity where price is the only variable that matters. And what that does is it erodes trust. It erodes brand trust, and it makes you vulnerable to every other competitive threat. And that's why I wanted to have this conversation today, because again, now I'm seeing in conversations that I'm having with fiber providers and I think, Zach, you're seeing this too, and I'd be very curious to hear your perspective here, but I'm seeing fiber providers now saying, hey, we've reached this level of take rate and it's starting to taper off just a little bit or flatten out a little bit. How do we continue to see this significant increase? Well, we need to drop the price and we need to run promotional pricing. And again, I think that's just a very, very dangerous game to play.
Well, you mentioned the generation that's been trained to think of this as a commodity here. What does the next generation value? Well, it values brand trust, number one. So this promotional pricing is I don't want to say it's not going to work here moving forward, but it's not what people value as they buy internet anymore. And Gabe, you asked a question here: competitive problem or is it a marketing problem? I do think it's both. We talked a lot last week about customer experience, going back to like the 7 P's of marketing here, number one. But if you bring this all together, I think it's a holistic problem. It's not one or the other, but how are you going to solve a competitive problem? Well, with marketing.
For sure. And it's also it's a customer feeling problem and an NPS problem too. I think there's a big reason why a lot of the larger cable providers or larger broadband providers just in general have had very poor to negative NPS scores over the years is because people got so tired of the massive increases in price. A lot of times I've looked at this a number of times over the years, Zach. I know you have as well, as you've done competitive research. But what's really interesting is how they price those increases. So let's say that let's just use a simple example, 3 service tiers, and there was a promotional price for each one of those service tiers. The largest percentage increase would always be on the cheapest service tier. So you may be paying $35 a month. I'm just throwing out random numbers here, but you may be paying $35 or $40 a month for a baseline service tier, for the cheapest service tier for 12 months. And then you know what that's going to go up to? $65 or $70 a month. And then if you've got the next one that would maybe started out at $45 or $50 a month, it might go up to $65 or $70 a month. And then on the most expensive tier, it may have been $80 a month for the promo rate, and it went up to $90 after the promotion expired. So I'm sure they tested this. These are smart people working in these companies, but I always thought it was interesting that the percentage increases were so much larger on those entry-level service tiers. But because we know that most people are going to buy the entry-level service tier, it creates even more of that problem where people are seeing this massive increase in their bill and having a negative experience and giving poor NPS scores and things like that.
That's really interesting, Gabe. I haven't looked into that at the level you have here.
Yeah, I remember doing this analysis when I was in customer success, and we were running a lot of these competitive webinars for a lot of the larger providers. And that was one of the things that really jumped out to me is once you start to line up the numbers next to each other, you see these massive increases at the bottom end of the market. So, I think that the part that I'd really like to get into, Zach, is you know me in math, right? Like I definitely want to get into some of the math
Gabe,
around this.
you said math twice in a sentence, and now half our listeners just switch to something else.
I mean, I said market cap like 6 times earlier in this conversation. So if they
who
haven't
doesn't
turned
love
off by
talking about
now,
market cap?
hopefully,
if they made it through last
interested.
week's episode, we still got them now. But Gabe, let's talk about the acquisition trap and the math that nobody except for Gabe is running.
Yeah, let's get into it. So, we've talked about this a little bit I think in previous episodes, Zach, but this is a challenge for larger public companies, for the Comcast, for the Spectrums of the world, because when they go out and talk publicly about their business, the first thing that the analysts ask for is, well, how many subscribers did you add this quarter? So I do. That I think is one of the huge things that resulted in a lot of this promotional pricing trap that we see people fall into. Growth looks great, leadership's happy, and then the easy wave kind of passes and everything stops. And most providers don't have that repeatable acquisition engine, right? They have a launch playbook, and the promo discount is what happens when you apply a launch area tool to a steady state problem. And that 12-month promo, we talked about seeing this in multiple meetings recently. It's not a retention strategy. It's a bribe to get someone in the door. And if you have no plan for what happens when the bribe expires, that is when you're going to see significant increases in churn.
I see that so much or so often, Gabe, with the CSPs we work with, let's get them on as a subscriber and let's forget about them. And we've always talked about how that is the worst thing you can do because not only are you risking them churning, but then you have to go out and acquire your next subscriber, and the cost of that has never been cheap.
Yeah, exactly. Well, that's the other big part of this, right? Is cost of acquisition in our industry is so high. So let's talk about some math here, right? So
Oh,
I'm going to use two different scenarios. I know, Zach, you can just chill out for a few minutes. I'm just going to go through
Can I
this.
just like leave the podcast for a moment and like come
Just
back?
walk away. It'll be fine. Come back in a
No,
couple of minutes.
no.
I'll still be talking about this. No, so let's talk about the math, right? Subscriber A, the promo path. So let's say they were acquired at $40 a month on a 12-month promotional rate. Price resets to $65 a month 13. I think it's a very realistic scenario that we see in many situations with providers. What happens when the subscriber churns at that reset point? So total revenue is $480 over those 12 months. Now let's do a comparison to subscriber B and the value path. Let's say that same subscriber was acquired at $60 a month through, a proper outreach, maybe through a referral because you've got such great NPS scores, through a community event, right? There's no promotion here. And let's say that customer stays for 7 years. That total revenue is $5,040 over those 84 months versus the 12-month scenario. So subscriber B generates almost 11 times as much revenue as subscriber A, almost 11 times as much customer lifetime value, even if we factor margin into that conversation, which I'm not going to bore you through those details of the calculations. But again, even if we factor in gross profit or gross margin here, it's still 10 times as much value that we're getting from subscriber B versus subscriber A in that scenario. And in a high cost of acquisition business like we operate in, subscriber A is destroying value of your organization. And you have to get, if your churn rates, unless your churn rates are, significantly lower, in situation A, again, you're just destroying value for your business in that scenario. So I think it's really instructive to look at, and that's a simple example, but I also think that's a pretty realistic example, Zach, of what we see out there in the wide world.
I totally agree, Gabe. And basically what you alluded to here is we have this high ARPU today, but all it's doing is masking this terrible customer lifetime value over the next few months or the next few years at that price reset moment.
Yep, exactly. And, if you're a massive organization like the large cable companies that we've been talking about before, you know, they can somewhat afford to lose 120,000 subscribers in a quarter because they still have 29 million subscribers left. So it's less impactful for them because they have economies of scale. If a community provider loses 5% of their base when that price resets and people move from month 12 to month 13, that starts to create a pretty existential problem for, what a provider's future, really financial and viable future looks like.
So, Gabe, if ARPU is the wrong measurement here, it's the wrong thing to look at. What should we be looking at?
I mean, my favorite metric. It's
I feel
it's
like I just
customer
mentioned it.
lifetime. It's customer lifetime value. No, you said it, and it is. It's so important, and it's customer lifetime value is the most important metric in the broadband service provider space, in my opinion. And I think the other piece of this is the comparison of customer lifetime value to customer acquisition cost is probably the most important ratio that somebody needs to look at. So it's looking at that balance of how much is it costing me to acquire this customer and how much ultimate value am I getting from them over the entire life of that relationship. And when you're putting a promotional price in place that expires after month 12, you're creating that churn risk that's going to drive down customer lifetime value broadly across the entire subscriber base. Not every customer is going to leave at month 12 or month 13, right? We know that. Some people are just gonna be like, man, whatever, it's okay. It's a pain. I don't want to switch, right? Like there's going to be some people that say, yeah, exactly, right? There is a pain of switching. And that's what companies are betting on. They're betting that people are going to say, it's too much of a hassle. I don't want to change. Therefore, they're going to stay. And there are a lot of people that will do that. But again, if you look at it longer term, in my view, and I'm not saying that the only reason that, Comcast and Spectrum's, values are down or because of this, but I do think it's a big contributing factor to the overall value of these organizations.
So, Gabe, let's talk a little bit about what what we should be doing here. And I think it's not so much a spend more on marketing conversation, but more about, who are we selling to and at what stage of the relationship are we doing that at? If we take that promo pricing off the table, what do we replace it with? What else do we use here? And Gabe, I think there's some good news here that community CSPs have advantages in areas that these big cable providers don't.
For sure. Yeah, and there are certainly advantages to being nimble. Zach, I think back to the conversation that we had with the Next Tech team at Connections, when we had that conversation about some of the things that they've done from a move-in perspective, how they've worked with local realtors, how they're providing gift cards for local restaurants, businesses, those types of things to incent people to sign up for their service. I think that was such a clever way to get in front of that new mover segment, because we know that that's a challenge. And it's funny because I'm sure you've heard this over the years too from customers you've worked with, but for providers who are in smaller areas that are competing against some of the larger companies, they have a hard time with brand awareness, because even though people moving into the area may not like the large national providers, they know the large national providers. So what do you have to do at that point to differentiate yourself? And, I think some of this gets back to, leveraging technology, whether that's AI search and getting in front of that, making sure that you're showing up in the right way. But some of it is just doing these kind of guerrilla marketing things of, actually getting out in front of the people who are supporting the communities that you live in to make sure that they're talking about you as well.
Yeah, but I see this so much. I live in a rather transient community, big college town, so you get those populations coming and leaving often. And when my town was overbuilt by a fiber provider, people often go to Facebook and say, "Hey, who do I get for internet?" And the default was big cable company every
Hmm.
time, and it's from people who don't know there's another provider, or I don't want to lean into like, oh, fiber's better, but they don't know that this better experience awaits them. And then next thing I knew, farmers market everywhere downtown. You see them all over the place, and it's shifted over the past few years now. But in the past, it was cable provider is your choice, and it makes me sad because I'm moving here after this episode, and sadly, this fiber provider doesn't exist at my new place, so I will have to go back to big cable here. But that's a problem I'm going to tackle a different
You're
day
going to be
here.
so unhappy, man. I can't. We're going to just hear bitter Zach now from now on with
No,
his
no.
crummy cable service.
Well, if you keep in mind when we started the podcast, I was on, crummy cable service, and it was the upload speeds that got me
Yes.
with the podcast episodes. But it
Yep.
just goes back to that move in moment and how important that is too.
Hmm.
Um, and that's just, and it ties back into the referral in the community. I've told everyone about this fiber provider. I'm going to tell my my new landlord company about this fiber provider. I gotta build
Uh,
myself up to that one. I can't just go in on day one and be like, hey, you
hey,
should
yeah, you
get
guys
a
need to get
bulk
some
deal
fiber in
with.
here.
Yeah,
Yeah.
like we gotta fix this problem. But it's a conversation I plan on having. But again, it goes back to your community is one of your best acquisition channels. I've
Hmm.
always said it's your best salesperson, and you don't even have to pay them.
100%. Yes, this is why positive NPS scores are so important. Having that positive PR story in the communities that you're serving. This is another area where I think the community service providers are at a real advantage, where many of them do have really positive NPS scores. What I have also seen is that many of them are not activating those promoters as much as they should. If you have
Mhm.
somebody that gives you a positive NPS score, you should immediately be reaching out to that person, offering them a referral code to go refer friends and neighbors, and also telling them to go leave a review on Google. That's a virtuous cycle. They're going to leave a positive review. When people are searching for new service providers, they're going to see that positive review. And as we have talked about in previous episodes, Zach, those reviews have become so much more important in an AI search world, because AI does a really good job, for better or worse, pulling out reviews and feeding them into the results that people are seeing when they search.
I've said it so many times. I've said it once in this podcast episode. I'll say it again. Your NPS promoters, your people who are out there promoting you in the community. These are your best salespeople. Leverage that channel, as Gabe just mentioned. If you've done, a recent NPS study, action that data. Don't just say, "Oh, we have a 72 NPS. Cool. Now what? What's that next step?" Think about that. Yeah, these are conversations you and I are always happy to have. But going beyond the community too, we've talked about this quite a bit in the past too. But selling on value
Hmm.
based tiers that aren't focused on price. Instead of discounting that same product or using that same strategy that's existed in these markets for decades, create something that's genuinely differentiated, um,
Hmm.
something that people want to buy. Sell the experience and not the megabits. I can tell you, every single subscriber that I have referred and I've signed up for my fiber provider, um, they don't know what a megabit per second is or a gigabit per second is. I told you they asked if the Verizon 5G was faster than the 2G plan, which was a whole another conversation there. But it just shows that people don't understand what they're buying. But if you can make it so they understand what they're buying, or make it so what you're selling is easily, digestible here by your subscribers and by some of these AI engines as well, it totally flips that conversation.
Yeah, for sure. And this is also where I think bundling becomes really important. And, this is an area where the large cable companies have actually done a pretty good job. I mentioned that they've been increasing their mobile subscribers. They launched mobile because they wanted to sell broadband. They're not making any money on mobile or very little money on mobile. It's the same play that they had forever with video. And that's the sweet irony of all of this is again, they're not making a ton of money on mobile, but it allows them to sell a very, very highly profitable broadband service and create that stickiness with customers. I was doing some competitive research this week for a meeting, and one of the things I noticed with large cable, national cable company is when you go through their buy flow, you purchase the initial service tier, and then they had a bunch of add-ons, Zach. They had like a managed Wi-Fi add-on, they had a security and parental control add-on, then they had an outdoor Wi-Fi add-on, and I think there was actually two versions of managed Wi-Fi. There was like a basic and then a premium version of
Oh
managed
no.
Wi-Fi. Dude, brutal, just brutal. And it when I presented this to the customer that we were meeting with, I said, "Look, your competitor just did you a favor here, right? They're making it really hard for the customer to get the best possible experience that they're going to get. This is an opportunity for you to bundle it in and into to your point on the value-based tiers, into a service that actually makes sense. So it can't just be about value-based tiers. It has to be about what are the additional services that you're putting together to make that product actually sticky and make the cost of leaving so much higher because your customers bundled into these other services. The bundle is the moat. It's not the price that you sold it to, it's the bundle that's rolling all of these solutions together.
So, Gabe, if you were hired as a chief marketing officer for a communication service provider in the next week, and your CEO came down and said, "No more promo pricing starting next quarter," what's the first thing you'd go out and build?
First, I quit and then start updating my resume. No, I'm just kidding.
It's
Yeah, it's a great question. So I love the idea of being faced with this problem and thinking about it differently. And I think the shift that needs to happen here is we need to start thinking about optimizing not for subscriber count, but optimizing for subscriber quality. And that really changes who we target, how we onboard, when and how we raise prices, and how we handle that inevitable conversation when a competitor offers someone a better deal. It's about, from my perspective, having confidence in the solutions that you're selling and also making sure that you're targeting the right customers for that. And well, I shouldn't say there will be customers who are just looking for the cheapest price, and that's okay. And 100% take rate is never going to be achievable. I think that's the biggest thing that I would be, going back to my CEO on in that situation is, okay, I'm very ready to do this, but you got to understand that we're going to be targeting a very specific type of customer, and our subscriber counts may not be increasing as fast as they were before. But what we're going to do is we're going to optimize for a quality subscriber, and our revenue and our ARPU is actually going to increase,
and
and our customer lifetime value is going to increase,
that's what I
right?
was going to ask you, Gabe. Which metric are we
Yeah.
focusing on?
Yeah, I mean, the increase in ARPU, the decrease in churn is going to have the positive benefit of customer lifetime value increase, right? But that's that longer term play. And so I realize that it's sometimes difficult when somebody is pressuring you and your goals are around, how many subscribers am I adding this month or this quarter or this year? But I think it's really important to take a step back and to look broadly at what's been happening in our industry over this longer period of time and use what happened with the large cable companies as a cautionary tale. And if somebody is coming to you and saying, we need to slash prices in order to increase our subscriber count, what happens in 3 years? What happens in 4 years? What happens when the brand has been eroded to the point where they don't see any difference between you and those large companies that have been running that playbook forever?
I think, Gabe, we've done a couple podcast episodes with John Pico. I think those would be fantastic supplements for this conversation of how you're
Yes.
going to, you know, change the vision of your organization.
Hmm.
Um, with that too, though, first thing to go out and build, Gabe. I think you summed it up there perfectly. In my opinion, it's going to be more of a focus on customer experience. And I also look at some of the leaders of customer experience outside our industry. I think of Apple. I think we all can agree that Apple has an amazing customer experience, except for when you're working with their development team trying to submit an app and you've got 100 vibe coders, or what was the game, 1,000 people submitting apps an hour, I think Tim Cook
I think it was
said.
1,000 an hour is what you said, which is just
And
completely
just
insane.
that degrades the experience there. But if you think about
Mm,
Apple's experience, they're not the cheapest product in the market by far. They don't pretend to be.
mhm.
But yet you're going to have a good experience from buying that service to unboxing the service or the product, as we mentioned here last week as well. So
Yeah.
I go back to marketing, I go back to customer experience, and I think something our BSPs or CSP customers aren't great at is just blowing things up when it's not working, right? How do we
Mhm.
just look at this entirely differently, right? You don't have to fix one piece of the puzzle. Maybe the entire puzzle needs replaced. There's conversations like that might be worth having too. But again, I just think it goes back to customer experience. And if your competition's offering this exceptional customer experience, maybe that's what we should be doing. Forget about, lowering prices. How do we beat them on the customer experience?
For sure. And one area where I think the community service providers or a lot of the providers that we do work with, Zach, have a massive advantage is with trust. They are trusted in the local community. They have that local trust, that community presence. And to your point, that ability to build these unique experiences that frankly make price irrelevant. But you cannot do that if your default acquisition motion is a 12-month discount. The math just doesn't work because the churn cycle doesn't stop. And month 13 always comes around, right? Where you're going to run into these situations where people hit that promotional period end, and all of a sudden it becomes a price conversation.
And by the way, if you are marketing or, if you are a market leader here, and you're tracking your churn reasons and you see someone go to this competitor, keep in mind, what those promotional periods are as well. Use that to your advantage. If you know that their
Great
promotional
point.
pricing is ending in 12 months, let's get out ahead of that. Let's talk about how their pricing is going to increase, or how their pricing is going to change with that promotional period ending. And then again, we focus your brand on the experience, the value, and win them back. So there's a lot that can be done there, Gabe. But promo
Hmm.
pricing past 20 years, from what I'm hearing, Gabe, maybe not the best way to move forward.
Well, I mean, I think if you look at the value of the companies who have been running that playbook for 4 of those last 2 decades, it's
Look
not
at the
great.
sentiment of these companies, mind you.
Well, great point, right? You look at both. I mean, the sentiment is extremely poor. As I said, NPS scores are often in the single digits or negative. And then you combine that with the financial outcomes. It's pretty clear to me that this is not a winning strategy. And I want to be sensitive to the fact that it is hard to hold the line. It's hard to hold the line when your board is pressuring you for subscriber growth, when your bosses are pressuring you for subscriber growth, when your bonuses are tied to subscriber growth. But I would argue if that's what we're always focused on as an organization is just that subscriber count number, we're not optimizing for the right metric. And if you were listening at all during this conversation, you know what that right metric is. And it's important to optimize around the right thing that's going to build value long term for the organization.
Absolutely, Gabe, here. We still have that local trust, that community presence, and the ability to build these experiences that make that price point irrelevant. This is something the big providers are not doing and cannot do to an extent. So, when we bring in the math, the churn cycle doesn't stop. There's always that month 13. And Gabe, to your math examples earlier, just a great new way to look at your products and services.
Love it, man. That was a fun conversation. Hopefully it was helpful for people. And
Well, of course it was fun for you. We got to talk about math and whatnot. But Gabe, I can't wait for our next episode. We should have a big episode. Once I get my new studio built out, I still think I need like a neon buffering sign in the background here. But
that would be so epic. Nothing would make me happier. If they weren't like $2,000, Zach, I would totally buy you one and send it to you. But we need to monetize buffering a little bit more before I can afford that.
Yeah, I can't blow our decade budget on a single neon sign. Exactly. But and to those who are missing the context there, we absolutely did quote a neon sign as a joke because I think it would look good. It gives you like a brick wall behind
awesome.
you and like some like dim lighting to you, rustic. I think it would look perfect.
It would look amazing. Yes, but yeah, we definitely can't afford that. So we're gonna have to just roll with what we got. But your setup will be better the next time we do one of these. We can promise that.
I'm very excited. And Gabe, like I said, not in your neighborhood yet, but I am closer, slowly making my way closer. Slowly making my way closer.
Hang out with me right like this. It'll be great.
Yeah, well, let me know how the housing prices are. But thank you, everyone, for tuning in to Buffering. And if you enjoyed this episode, don't forget to follow us on your favorite podcast app and to share it with your friends and colleagues. And for more insights and updates, be sure to connect with Gabe and I on LinkedIn.